Welcome back, students who are taking financial accounting, and in this series of videos we are working on the chapter 4 short exercises. We finished off in the last video with 4-6, and as always, if you don't get the answer when you're watching the solution here, I mean, when you watch the way I work it out, that should take care of the application aspect of it, okay? Because you're just seeing how I'm working through the problem. But if you don't understand the concepts, then you need to go back through the theory videos and watch those again. And if not, if you still don't understand something, feel free to contact an instructor. Okay, so and by the way, I put that caveat in here always in the front because I don't know if you're just looking at this one video or you're watching them in series. So that's why you have to keep on listening to the to my little rant there about watching the theory videos. So 4-7. All right, journalize the sales transaction. Journalize the following transaction. Right, Pool Palace sold $8,100 of merchandise to Royal Spas Inc. on account. Terms were $415, net $60, and the merchandise cost the Pool Palace $44,500. Okay, so whenever you make a sale, okay, let's deal with, there's two aspects here, okay? This is the first one, and this is the second one, right? To this problem, to letter A here. And let's deal with the first one. We're selling $81,000 of merchandise on account to Regal Spas. So am I affecting cash? No. Am I affecting accounts receivable or payable? Yes. I'm affecting accounts payable, so I'm going to credit accounts payable for $81,000, and I'm going to debit sales revenue. Oops, I'm sorry. I'm thinking about the last problem here. I am going to debit accounts receivable, all right, and I'm going to credit sales revenue. Even accountants make mistakes, right, for the $81,000. Okay. Now, whenever you make a sale, if you're selling something out of inventory, you always have two entries that you have to make. You have to make one for the sale, and then number two, you have to make for, costing the inventory, meaning taking out of inventory and putting it the cost of goods sold. So, our inventory is an asset account, and it's increased on the debit side, right? So that means we have to, since we're decreasing our inventory, we're going to credit the inventory account for the for the 44,500. And since we have to debits equal credits, we have to debit something else, and that debit is going to be our cost of goods sold account. Boy, I'm having a difficult time for this one. Cost of goods sold. Cost of goods sold for 44,500. Okay, so again, I mean, sure, here in this problem, they're telling you they're making a sale, okay, which was number one here, okay, and then they're telling you that this is the cost, so you know how much the cost is. So whenever you make a sale, you, number one, have to record the sale. That's one journal entry. And then number two, you have to take the item that was in inventory and expense it the cost of goods sold so that you can match up your revenues with your expenses. I mean, look at it right here, okay? You have sales of 81,000, and then you have your expense, which is what it costs you, of 44,500, and the difference between the two is what? 0.056 $3,650 of gross profit. Okay, and gross profit is before your selling and admin expenses. All right, and then that of course gives you your profit or loss on your income statement. So revenues, cost of goods sold, gives you your gross profit, right? And then you take out your selling and admin expenses, and that gives you a profit or loss. All right, so You always have the 2 entries to make there if you're removing something from inventory. Now, if you're using the perpetual system where you're keeping track, like you have automobiles, obviously, you can keep track of which automobile, and as soon as you sell an automobile, you can take that out of inventory. But if you're like a grocery store, remember the inventory account, you're either using the perpetual inventory system, meaning anything that goes in and anything that comes out, you make an entry for. And therefore, when you get to the end of the accounting period, what you have on your books should be what's on your, in your inventory. If it isn't, there was a mistake made somewhere, or maybe something was stolen and you have to adjust for it. Or you're using the periodic method, which means you start out with a beginning balance and then you just, you keep on applying, adding any purchases, but then at the end of the accounting period, you do a physical inventory and you make an adjustment to the physical inventory. All right. Well, if you were recording sales here during the course of the month and not making this entry because you're using a periodic system, when you get to the end of the accounting period and you do the physical inventory, well then yeah, you're going to make the adjusting entry with, to move everything out of the inventory and put it to cost of goods sold. Okay, so that's one. A, and then B says receive payment for the goods from Regal Spas within the discount period. Okay, so let me just draw the line here. Okay, so now for B, you're receiving the payment. Well, if you have an accounts receivable for $81,000, it was a debit, that means you need a credit accounts receivable for the $81,000, so that's a wash. All right. And of course you're going to receive cash. Well, how much are they going to be paying you? Well, you had $81,000, and since the terms were 4% net 15, that means we would either subtract 4%, we'd figure out the discount of 4% by multiplying by 4%, which gives us, let's see here, 3240, right? And then you take your 8100 less how much they discounted, which was 81,000, less your 3240, which gives us 06777, right? So they're going to pay you cash of 77,760. That was one way of doing it. The other way of doing it was taking the 81,000, and since the discount is 4%, that means what they're going to pay is the reciprocal, which is 96%. And by the way, this concept is covered in the Math for Business and Finance. It just popped into my head. So, a lot of this stuff you've already had before, and if you don't remember it, then go back and visit your math book. Okay. And so 96% of 81,000 is 77,760, right? And then of course to figure out the discount, you take 81,000 and subtract 77,760 to get the 3240. Now, in the theory videos, I had said, there's the two different ways of doing it. There was doing it one this way by taking the 4% to get the discount, and then subtracting it to get the how much you're going to pay, or two, you would just multiply by the 96 to find out how much you're going to pay. But notice that you still, in this case here, you still have to make the second step, okay, of subtracting one from the other in order to figure out the discount. All right. So me personally, I had alluded to doing it this way all the time, and even though at times doing this is shorter only if you want to know how much you have to pay and you're not interested in how much the discount is, you wouldn't have to do that calculation, so you're only doing one step instead of two. But for the most part, the vast majority of the time, you're going to end up doing both steps anyway, so it just makes it easier for you to do it, in this fashion. Okay. All right. So if my if I'm paying cash, right? If I'm receiving cash because I made a sale and they're paying it off, I'm going to debit my cash, for the 77,760, and then of course I'm going to credit my sales discount. I'm sorry, I'm going to debit my sales discount for the 3240. Okay, now the question might come, why am I choosing sales discount? Well, remember, I mean, if your chart of accounts only has a sales revenue account on it, okay, then yeah, I would have debited my sales revenue. And if I looked at that T account, you know, I would have seen that I had a credit of 81,000 for sales, you know, for the original sale, and then I would have had my discount of 3240, which would have made the balance in the account 77,600. And that's fine if that's all you have is this revenue account. But notice when you have a lot of transactions, any discounts or returns and allowances that you have get lost in this net sales amount, right? Some businesses want to track, you know, they want to do more analysis than that, and that's why they create the additional sales discount and the sales return and allowance account. In doing it that way, when they have the original 81,000 in the sales revenue account, well, the balance in that account is 81,000, so they know how much they made, you know, how much they made in sales. But they also are able to track how much they gave away in discounts and how much they gave away in returns and allowances. Okay, and that's where the concept of net sales revenue comes in. Net sales revenue. Okay, so that when you're showing it, you're showing your sales revenue, and then you're showing your discount, and the difference between the two is your net, and also returns and allowances if you add it in. The difference between those is your net sales amount, and you're able to track and say, okay, I had 81,000 in sales and I had 3240 in discounts. Sure, my net still ends up being 77,760, but I can analyze this information a little bit better, whereas just having the one account, everything gets lost in the shuffle. Okay, all right, so that's it for that particular problem. And with that, I don't know why I'm erasing all of this, but I'm going to stop here and pick up in the next problem. Okay.